let's talk about supply and demand, a very important concept for trading the financial market, be it forex, stocks, crypto, anything you can think about. This video is going to be a deep dive video into supply and demand. So make sure to like this video right now, subscribe to this channel, and let's get started. What is supply and demand? Supply and demand are basically areas in the chart where traders enter the market with enough volume, causing the price to move sharply from that particular level. So let me make you understand this concept very well. All right, so let's say there are 50 iPhones and it is currently sold for $100 and 500 persons are interested to buy these iPhones. Mind you, there are only 50 iPhones. What will basically happen is this phone is going to sell out very, very fast. What does that mean? It simply means there's a lot of demand for iPhones. Now, if we flip it the other way around, let's say out of the 50 iPhones, only 10 persons are interested to buy it. What happens is the supply is higher than the demand, and therefore the price is basically going to come down. And this is what is applicable in trading the financial market. So you have something like this where the market is trending upward. People are basically buying at these prices here, and this is what is taking the price upward. Now I can mark out this area here. Now this area here is our area of demand. Now why is this the area of demand? This is because some of the persons that missed out on buying this when this price was around this area, they would most likely be waiting for it to come down because they probably think the price of this thing is too expensive at this top. So the moment they see a retracement to this region, you see these people start buying up instantly, and then we see the price going up automatically. Now let's replicate this for supply, and which is for bearish market. So in this particular case, we have something similar like this where the market is trending downward. So some persons want to actually short this market, or they want to sell the market, but they don't want to sell at any of these prices here. Rather, they want to wait for this price to come back to this area here before they can take a sell position and then sell it lower. So this is basically the concept of supply and demand. So supply and demand is basically the last candle before an impulsive move. So this particular candle here that led to this impulsive move is actually where your supply is. Likewise, this one right here, this particular candle was responsible for this impulsive move. So therefore, this area here is your area of demand. So let's go back to real chart and let's talk about certain things. So I'm going to look at this particular coin right here. Now, one of the important rules for supply and demand is you need to follow the trend. So basically, you want to find out if the market is in an uptrend or in a downtrend. I've taught you guys about how you can do that, but if you don't know how to actually look for uptrend and downtrend, you can basically check out my previous video about market structure where you find that out. All right, so when you look at this is an uptrend. Now, why is this an uptrend? It is basically because we have been creating higher highs and higher lows, higher highs, and this indicates that we are in an uptrend, right? Now, what you want to do is to find out the area of inefficiency in this particular market. So I'm going to start with this current trend right here, which is this move to this upside, right? So how do you find out the area of inefficiency? This area here was an area where market moved up swiftly, creating a gap. So where's the gap? This area down here up to this area here was actually the gap. Some persons might term this as fair value gap. You might want to look at it the same way. Because of this huge move to the upside, there was actually a gap created. Now, where is your demand in this particular area right here? Your area of demand is actually the last candle before this impulsive move. So where is the last candle? It is actually this candlestick right here. You draw it out. So this is your last candle. Now, because there is actually a wick below that particular last candle, what you want to do is, so you want to accommodate that wick as part of the candle to cover up for it since that wick was created. If you look at these areas here, do we have areas of inefficiency? Yes, we did have areas of inefficiencies here. So I'm going to draw out this one right here, this area here. So there's actually a gap right here. I can drag this to the forward. Now, some persons might say this here is a place where we had a gap. So what you can see is we've actually come down to fill this gap completely, and then we've gone up. So this is not a potential area to capitalize. Let's look out for other areas here if we can find any. So there is a very tiny one, almost I can zoom this out and look for it. So this here is another area, very small actually. So these are like your fair value gap. Now what you term as the area you draw for your support or demand is basically the candlestick that's led to that impulsive move. So for this one here, we have this candlestick, right? We have this gap, right? So which candle led to that impulsive move? Well, this candle here was responsible for that. You can draw that out to the downside. We also had this move right here, which created a gap between here and here, right? Now what you can see is we've come back to fill this area, so this gap is no longer important. So next we can see a slight gap between this area here and this area here. So this has not been filled, so we want to draw this out, and we can use that same method. You can see there is no other gap in between aside from this area here, this particular one. So we can basically draw this one here. So this was the candle that led to this impulsive move. All right, so right now we have different demand zone, so you can term them as demand. So we've been able to identify different areas of demand right here. So which is the best area to capitalize on? So first thing first, like I mentioned, you need to follow the trend. This is an uptrend, right? Now what you can see is we broke structure here, showing that the market is still bullish, and then we had this retracement down here to this upside. So right now we've been able to identify the areas of demand. Now let's take example as the first demand area we can see here as our entry point, and then we target lower as our stop loss and target higher prices. So let's see what actually happens after here. So I'm going to play this, and boom, we tagged in over here, and then what happened next? You can see we did take profits on this particular one. So automatically we have a new range. We've actually broken structure here, and I'm just going to push this so we can see this area clearly. So the moment we've broken structure, the next thing we want to ask ourselves is, where is the leg of price that led to this break of structure? It is basically from this area to this top right here. So this is our new range. If we have something like this where market comes down and break this region here, we want to be scared that the market is reversing, and we might most likely see the market dumping. So therefore we might start seeing things like this going downward like this. So we want to maintain this particular uptrend. We want to maintain this particular uptrend, not changing character in this particular scenario here, because if it changes this character, it simply signals that there might be a potential downtrend in this particular situation, and in that situation, all of this demand area here we should be careful with the way we treat any of the demand section down there. All right, so let's go ahead. Now what you can notice is we came down again to this area here. You can see we came down to this area here, and we had a very good entry to the upside, but this here is not a potential trade. Now why did I say it's not a potential trade? One thing you need to understand is you need to focus on one tap. Whenever you have more than one tap, then you should be careful approaching that particular demand level. It played out very well here, but there are certain times when overall, after you've done your backtesting, you discover that it is not actually the best places to actually enter a trade. So whenever we had our first tap here, which was our demand region, any tap coming back to that same region is not supposed to be a trade. But though this played out very well, so you just have to be careful, because the more it touches, the more likely it goes down below that particular area. So you just have to be careful when playing around that. All right, so when you look at this right here, this is basically an uptrend, right? So basically we created a high, a low, and then a higher high. So this area here is our current range. So this area right here is our range. Okay, so anything below this simply tells us that we are going into a downtrend. And what you can notice around this area is we had some gap here, right? We had some gap in this area. You can label this as your demand. We also had another gap in this area here, which is very small. You can see from this point here to this point, It's a very insignificant gap, but sometimes it also presents you an opportunity. So this leads us to where was the last candle that led to the inefficiency? This particular candle right here. So we can draw this to this side. So we have two levels of demand in this area here. Now, which particular area should you focus in this particular scenario where you have two areas of demand? For me, I like to focus on the extreme one here, which is this last one here, because I prefer to buy from here. So we have something like this, I buy from here and target higher prices over buying in this area here. So the basic reason why I prefer to do that is, let's say for instance, I take a long position from here and then my stop loss here, and then we see something like this, we get kicked out. We've been kicked out of this trade, but what you will notice is we are still in an uptrend because we've not broken this low here. So we are still in an uptrend. So you basically lost out on a trade. So we could have something like this where it breaks this region and still continue upward. And that's because we are still in an uptrend. So it doesn't make sense if we're in an uptrend, but we're taking a trade and we're actually losing in that particular trade. All right. So that is why I'm going to target this area here, and then have my stop slightly below this lows there, since this is the lowest point. This is the last candlestick here. I have my last thing slightly below that, and that should be the area where if it breaks below it, I potentially know that we are going to see more down. So now you might be asking me, there should be other ways where you can enter a trade here, because I can tell you several times where we have something like this, it comes to this area and pulls up to the upside instantly. So what are you going to do in this kind of scenario? Well, what are you going to be looking at for is, since we market is going down, we want to see a position we want to take in position from the down to the upside. So what you want to do is to look at for a pattern like this where we are coming down, we go up, then break structure right here, which normally should show that we are still in a downtrend, and all of a sudden we break above this, which signals a change of character, and then we start looking for lower prices to enter at this area here. So this area right here, and then we take our long from this particular area here. So that is what, if you want to use this, you can use that for this confirmation entry in this particular area if you want to actually enter here. So you do something similar. The markets come to this area, goes up a little, come down to break structure, and then come up here to change character, thereby giving you chances to look for a long position to take it to the higher area. So this here, you're going to look at it at lower time frame, not at this daily time frame. You're going to be finding it in lower time frame, maybe 1 hour, 30 minutes or something. And if you see this kind of structure, you should be able to take your long in this area here. I'm going to talk more about it shortly, but you're going to take your long in this area here and then target here, since this is the change of character that we should be expecting prices to be bullish. All right. Otherwise, if you don't see anything like that, then it is your sign to stay away from it and target this particular area here. Because if you enter here, what happens is, if you lose this particular trade, it simply tells you that you are wrong, but it actually signals a change of character, which tells you that the uptrend is over and we should expect prices to start going lower. So in that situation, you're not going to blame yourself so much as against when you take position from this particular area. Okay, so let's play this. And what did you see? If we had our entry here, we had a very good entry, and boom, we went higher. And this played out like that continuously. Now let's look at for another example. All right, if you look at this chart right here, we're basically in a downtrend, creating lower lows, lower highs, lower lows. Let's look at for this variable. This is a 1 hour time frame. Now what you can see is, after this lower low, we had the lower highs, we created another lower low. So this here is our break of structure, right? Now what did you see afterwards? What you can see is we closed above this previous high, creating a higher high. So this here is our HH. I'm just going to take it to the upside so it's clear. So this here is our HH signal, showing that there are chances that the market is going to reverse to the upside. Now, when you look at this, we had our area of inefficiency right here. So with that, we should be able to highlight the area where we are going to have our demand. So our demand is this area right here. Now, what should we expect? We expect that price should come down to this area and then target higher prices. So with that, we could have our entry point in this area here, and then our stop loss slightly below it, and then we target higher prices. Okay, so let's go ahead and see what happened. So we tapped in, and then boom, we went up instantly, and we even went way higher than the previous highs right here. But to be conservative, I'll tell you to target the highs over this area here. So if you look right here, there's still some level of inefficiency. That's FGV, fair value gap. So if I want to target higher price, that's if you're aggressive. But yeah, conservative, you got your trade. And then next, let's see what happens next. So this automatically tells us we are in an uptrend, right? So basically broken structure, more structure here, showing us that there are chances that we are going to continue higher. Okay, so what you want to do is, where are the new areas where we have inefficiency? Here we have inefficiency here. So you simply draw this, and this is your new demand area. So here could just be your demand area. So let's take a long position, and then a stop loss slightly below it, and we target higher prices. Now, sometimes if you want to be conservative, some persons might want to drag their stop loss below this just because they are scared that this sweeps below this. It's still fine, but the only thing is it reduces your risk to reward ratio, which you can see right here. Okay, so depending on how you want to play it. Okay, so next, let's see what happens. We tapped in beautifully, and our trade activated, and then we went higher, giving us a good 1 risk to reward 5. And we can check for areas where we have inefficiencies, because this is still an uptrend. We've basically broken structure here, showing us that the trend is not over yet. So we just want to ride with the trend. So where do we have new areas of inefficiencies here? We have this area here. So you mark out the candle before it, and this becomes your new demand. Do we still have area of inefficiency here? We have one here. So and then we still have one here. So I'll just basically stick with this one. We also have another one here. And if you look at this area here, something that happened there, we went up, retraced, and then continued. So this area cannot be ignored. You basically draw your candle, and just like that, you should be able to find out. But you can see price did not come down at all. It's still trending upwards. So there are chances that we could come to this area and then have a very good trade to the upside, or we basically come down and test this area. The good thing about this is, if the market comes down here and then start going up, very good. But even if it still decides to come down here, it doesn't change the fact that we are still in an uptrend. That's because if you look right here, this was the previous low here. So our range started from here to this upside there, although this upside is not only confirmed, just because there are still chances that this might even go higher from here. So we want to make sure that we see something like this, where price goes down to some extent, then we now know that, okay, this might be our temporary top for now, and then this is our bottom, and anything in between this area is basically still an uptrend. The only time when we are going to be scared is when we have this break below this. Then there are chances that we are going to start trading lower. So otherwise, once we are still within this range, we are still in an uptrend. So the best areas to target is this and this one right here. So like I told you, you basically use confirmation entry to if you want to use this to enter the trade, you can basically use confirmation entry, and if you get that's fine. But I can also see more areas there, because there's an inefficiency here. So this here is still a potential area for demand. So it all depends. But for me, I'm going to go with the lower ones here, and that's because sometimes I can use Fibonacci retracement to draw from the lows to the highs, and basically focus on focus on the demand area or supply area above, within the 0.5 region down here. So anyone down here is preferable for me. It gives me a better risk to reward, and it's much more better in terms of the market. So I might want to stick with any of these ones here, but I'm only going to go for this particular one down here on the case that we have a confirmation entry, which I showed you, where we have something like this. Your market comes down, tap into this zone, comes up a little, break structure, and then change character here, then I can start looking for a long position here to target to higher prices. If I don't get this on lower time frame, possibly like 30 minutes, 5 minutes, or 15 minutes, I'm not going to enter the trade. I'll just wait for this area or potentially leave it. And even if I miss it, fine. But I know that it's way better for me to enter here. And if I want to enter here, I'll possibly just put my entry here and my stop loss slightly below this and target higher prices. This should give me a 1 risk to reward for, which is actually a beautiful trade. If you want to if you are very aggressive, you can reduce your stop loss a little bit, slightly below that area. Still very, very fine. So this is it about supply and demand. I hope this video was able to do justice to this, and we'll have a lot more videos in this series where we talked about all of these things. But if you enjoyed this video, make sure to like it right now, subscribe to this channel. You don't want to miss our future videos that are coming, and make sure to check out our channel to find out previous videos we've made about technical analysis. These videos are going to help you so much navigate your journey. Thank you so much for watching this video, and if you want to find out more details about fair value gap, I did a full dedicated video about that. Then click this video right here to watch now.